Hello, with me today I have star investor Bill Ackman, CEO of FTSE 100 company Pershing Square Holdings. Hi, Bill. Thanks for joining me today. Great to talk again.
Sure. Good to see you.
A lot's happened since we last spoke at the end of last year. The share price, the Pershing Square share price, has been a roller coaster ride, and more recently, you published half-year results. Is the business where you want it to be, and how would you summarise portfolio performance in 2022 so far?
Actually, I feel quite good about 2022. We've had some very significant profits from hedges, uh, decent percentage of which we've realized. So that gives us cash to deploy. That's offset some weakness in, I would say, stock price performance. We've definitely, I think the last reported return was probably something in the 13% range, something along those lines year to date. We're a bit ahead of the S&P. But we really focus on is the performance of the companies we own. And in almost every case, with one short-term glaring example, which was Netflix, which we can discuss, we feel very, very good about the businesses we own. Universal Music continues to perform extraordinarily well, and we expect it to for decades to come. Really every company we own has reported good results, actually quite strong results. Management, taking the right initiatives. We feel very good about the businesses. And what's happened is, the move in rates has caused, a re-rating in multiples and brought down kind of today's stock market value of these companies. But we like them on January 1 at the prices where they traded, and we like them more today at lower valuations. And we think, sort of finally the Federal Reserve is getting aggressive about tempering inflation. And I think that's important for the long-term value of these businesses. So as long as we're not in a world with runaway inflation forever, and even in that world, we own the kind of businesses for the most part that can protect themselves from inflation. So we like the companies we own. We like the prices where they trade. And then Pershing Square Holdings itself, the entity, the discount to NAV has widened over the course of the year. So the performance of the share price is disappointing to us because it includes further widening of the gap between NAV and share price. And we did launch a pretty aggressive share repurchase program. We're buying the maximum every day that we can in the open market. And the benefit for the long-term investor, obviously, is canceling shares at a 35% discount to NAV is quite a creative use of capital, particularly when NAV is comprised of businesses you really like that are trading at themselves cheap prices. So we're buying back stock today. And the last time we sort of did the math, we sort of estimated kind of if you took the kind of fair value of everything we own and they traded at fair value, that's a number, comfortably in excess of $70 per share. And we're buying back stock, today at $32 or $33 a share. And I think that will inure to our benefit over the long term. So, obviously very interesting, challenging year for the world. We try to own businesses that can withstand the test of time, and I think we've been successful in selecting them.
Well, Universal Music Group, which you mentioned, is easily your biggest position, and the stake was a drag on performance in the first half. Has your view on the business changed at all? Are there improvements you want the company to make, and what's the relationship between you and the board?
The relationship's excellent. My first in-person board meeting, I just joined the board relatively recently, is going to be this coming October. I've met directors by Zoom, but we have a great relationship with management. We love the business. I think it's a new board, but I think it looks to be a good board. No issues with anything the company's doing. I think there are certainly opportunities. It's sort of a U.S. Headquartered company with most of its, about half its profits in America, listed on Euronext Amsterdam. And it suffers a little bit, I would say, from what Pershing Square Holdings suffers from, where the logical market for that stock is probably NASDAQ or the New York Stock Exchange. And that's something the company can address over time. But the business is doing great. Earnings are up, well in excess of what we expected when we bought made the deal to buy the stock in August of last year. And just the multiples come down. It's trading at something under 20 times earnings for a business that we think can grow earnings at 20% or certainly high teens compounded for a long, long time in a, really undisruptible business. Ukraine is going through, a tragedy, and but my guess is people are still listening to music in Ukraine. It can appease, the mind at tragic times, and it's a kind of universal language, and you're going to see more and more growth in music streaming over time, and I think it's pretty inevitable. So we like inevitable companies, and we think we have by far the best management team in the industry. So there's nothing to complain about other than, I would say, in the short term, perhaps the share price. The other thing that is hurting the share price is the translation of euro to dollars. Right, this is a euro list, entity. We hedge our exposure to kind of Universal's operating income in terms of its euro and other currency exposures. We don't hedge, if you will, sort of the translation risk of the stock price. So I think the earnings are better than expected. Partially because I would say the business is doing really, really quite well, but over time we expect the market to give benefit for the fact that a lot of the company's earnings are in U.S. dollars, and the U.S. dollar is appreciated. The stock price doesn't yet reflect that, and we think it will over time. But again, great company, great management, very, very cheap stock. Shouldn't trade at 19 times earnings. It makes no sense to us.
Yeah, well, when we spoke previously, it was shortly after the Universal deal, you told us that you just stepped out of an investment meeting where you were looking seriously at a new idea. Now, I mean, you must have had many more of those meetings since then. Is there anything sort of catching your eye at the moment? Anything that you're working on? You won't tell us exactly what, but any clues?
Well, we've put on a number of other. We're spending a lot more time looking at kind of interesting asymmetric macro type instruments, and that's been a very profitable place for us. We've probably made $2.7 billion of profits on interest rate related hedges, and that's system wide. So about 90% of that's in Pershing Square holdings. We made a fortune on credit default swaps, another $2.6 billion in 2020. And we've always done these sort of hedges, but I think we're building a little bit more of a competency, and so I would say that most of the new investments we've made in the short term have been relatively modest in size. Instruments where we think, if the world macro events play out the way we expect, could become enormously valuable. Those interest rate hedge investments kind of totaled under 400 million, and they turned into $2.7 billion. It's hard to do that in equities, certainly in the short term. So, we love the super high quality, long duration businesses we own. That's kind of the engine of long-term growth of Pershing Square Holdings. And then opportunistically, we think there are occasionally things to do on the macro options or credit default swaps or swaptions or other instruments. And we've been spending a lot of time this year and finding some interesting, investments. I would say today that those investments are still a very relatively small part of the portfolio, but they have the potential to become quite large. We haven't identified a new stock to buy, but this is a super volatile environment, and the benefit of some of the realized profits from our hedges is that we can deploy them in undervalued equities, and we have a list of companies that at a price we would own, and they're getting closer to that price.
You made huge bets on credit default swaps, as you just said, during the pandemic, and then on a spike in inflation. I mean, as you made the trust billions of dollars. Do you have any similar trades running at the moment, or rather, are there any market bets you think might make sense in the coming months?
Yes, and generally, actually, to point out, they tend to be very large notional bets, meaning the size of the insurance policy is quite large, but the cost of the insurance or the cost of the hedge is generally quite small relative to the size of the policy. So we like that, as I like to use the word, asymmetry. So they tend not to be things where we're exposing a lot of capital to the risk of loss. But if they work, they can be meaningful. And yes, we've entered into several new such hedge type bets, different from ones we've done in the past. And I think partly it's it's such a volatile world, and uh, and we're monitoring lots of different, there are lots of different everything from commodities to interest rates to currencies that can affect uh, business values. And uh, if we have a different view from others, generally we can make those investments on very, very attractive terms. And so we like having a small portfolio of those kind of bets, if you will, as part of the portfolio. So that's really the only new stuff we've done in the last, several months.
Are you able to give us any details on those trades, Bill?
We can't, unfortunately. I think we always like to share everything we can, but nothing that would be a competitive disadvantage to PSH. And I think sharing that stuff at this stage would be a competitive disadvantage. But at certain points in time, we're happy to share our thesis, like on interest rates. If you follow us on Twitter, or you follow me on Twitter, I think we've been pretty prescient about, had you just actually built a trading account around our views on interest rates or our public statements on interest rates, would have done quite well.
I mean, of all those trades, I mean, again, you've mentioned of those that you can mention, you've talked about the credit default swaps and inflation, or it can be a stock or a hedge. Which of those trades are you most proud of? Which are your best calls?
I think we made a very good call on COVID, obviously, and I think we were very early and well rewarded on interest rates. So those have been. We want to do well for our investors, and obviously we've had some very nice multiples of investment capital that are material and big contributors over the last 4 or 5 years. And one of the, I don't know if you had a chance to read our semi-annual letter, but I actually took the time, something I hadn't done before, and looked up the 100 largest closed-end fund in the world, and was kind of surprised to learn that we were second by net asset value, third by market cap, and that's because of the discount to NAV, but the best performing in 1 year, 2 year, 3 year, 5 year, timeframes by a lot. And the other sort of anomalous data point is the discount to NAV was by far the widest of the 200. I think the average discount was something in the kind of, mid to higher single digits to NAV. So Lee, it's up to you to figure out why that yawning gap exists. We also have the largest ownership, other than I think 1 or 2 entities, one being like 100-year-old trust, to any, of the shares of any, manager. So I think you get the most alignment. You've had the best performance, certainly in the last, 1 through 5 years. You've had the historic record over 19 years has been, 700 basis, more, I think 700 basis points per annum above our logical benchmark. So at some point we'll be recognized. We look forward to that day.
Great. Bill Ackman, CEO of Pershing Square Holdings. Thanks very much for joining me today.
Thank you very much.